What happens when you sell an asset that you've been using in your business? If it's going to have made a gain, do you then forget about capital allowances? Or do you claim a balancing charge on it and forget about CGT? In this video, we're going to clear up any confusion on this. I have kept it fairly simple to try and get the point to sink in. There can be more complications than we mentioned in this video, so if you do have any questions, be sure to pop a comment below and I'll get back to you with an answer. Let's first of all look at the difference between capital gains and capital allowances. Capital gains are the taxable profits on disposal of an asset, whereas a capital allowance is a tax relief you're given for using an asset in your business. It's essentially the tax version of depreciation. Capital gains are taxed under either capital gains tax for individuals or corporation tax for companies. Capital allowances are given as a deduction from trading profits of unincorporated businesses and companies. Let's take a really simple example to illustrate the difference. If I sell a machine that I used in my business for £20,000 and I originally had bought it for £15,000, then I've made a gain of £5,000 on that, haven't I? That gain could be taxed under CGT rules or corporation tax rules. Straightforward enough and makes sense hopefully for you. But what do I do under capital allowances though? I'll have claimed some capital allowances already on it, probably about 100% of the cost. I need to get the actual asset out of my capital allowances computation though. Most likely I'm going to be removing that at the lower of cost and proceeds before working out normal allowances for that pool for the period. I won't actually be claiming any allowances on the asset itself that period unless it was an asset that has been depooled, perhaps because of private use, for example. In that case, I'd need to process a balancing charge or balancing allowance in order to make sure there was nothing left in that column of my computation for the next period. But what if I made a loss when I sold my machine? If I've been claiming capital allowances on the machine, which is more than likely, then I don't get to use the capital loss that I've made on the sale of that asset. Why? Well, firstly, my machine is a chattel. It's a wasting chattel, plant and machinery. Think about it from HMRC's point of view. They've already let you have capital allowances on that asset. That gives you tax relief against your profits. They're not happy about then you also getting to use a capital loss to reduce any chargeable gains that you might have made and would otherwise be getting taxed on. So if we go back to my machine, I bought it for £15,000, remember, and see now that I actually sold it for £10,000. Well, I've made a loss, haven't I? I still take it out of my capital allowances computation at the lower of cost and proceeds. So that would now be £10,000. And if it's an asset that was sitting in a pool, then we wouldn't have to be doing anything else with that. So there we have it, clarification between what we do when we sell an asset like a machine from a capital gains point of view and a capital allowances point of view. If that was helpful for you, please do hit the like button, drop a little comment below as well. If you've got any questions for me, please do. Lots of other videos on the channel for you to have a look at as well, and make sure you remember to subscribe as well for any notifications of new videos coming up too.